Ladies and gentlemen, welcome to the English Daily Book Summary YouTube channel. In order to not stop learning, listen to an English book summary every day for free.
James Da Costa, Fintech Wars, Tech Titans, Chaotic Crypto, and the Future of Money. Money moves differently in the digital age. Rather than passing cash hand-to-hand or writing checks, we tap screens to split dinner bills and apply for loans through algorithms. Fintech, which stands for financial technology, refers to any company that uses software to provide or improve financial services, from digital banking apps to online lenders. In this blink, we'll explore the origin stories of some of fintech's pioneers, from the consultants who revolutionized credit card lending to two friends who reimagined mobile payments. You'll discover how these innovators identified problems that others overlooked, survived existential threats to their businesses, and ultimately changed our relationship with money. Let's begin. Capital One and the rise of fintech. In the late 1980s, two business consultants, Nigel Morris and Rich Fairbank, developed an unconventional proposal. They believed banks could use algorithms and financial data to tailor credit card offers to individual customers, adjusting terms like interest rates based on personal financial behavior. At that time, most banks treated all customers the same, offering identical rates regardless of a person's risk profile. Their unusual proposal caught the eye of Signet Bank, a regional player with growing credit card ambitions. Soon the pair found themselves making grueling 100-plus-mile daily commutes to Signet's offices in Richmond, Virginia, determined to transform their vision into reality. The early days were anything but smooth. Customers weren't exactly rushing to embrace their novel card offerings, and inside Signet, pressure mounted as executives grew impatient. Morris and Fairbank began to fear they'd be shown the door before they could demonstrate that their concept could actually work. They were saved, ironically, by recession. When the early 1990s global economic downturn hit, Signet Bank started hemorrhaging money from bad real estate loans. As the bank focused on damage control elsewhere, Morris and Fairbank found themselves with unexpected breathing room. They seized the opportunity, launching a campaign offering lower interest rates to customers willing to transfer existing credit card balances to Signet. It worked, triggering a surge of new users. By 1994, their once small operation had grown enough to be spun off into an independent company called Capital One, with Fairbank and Morris taking the helm. Capital One began with laser focus on just one product, credit cards, but approached it with a unique strategy: constant testing. Every single aspect of the business, interest rates, promotional offers, customer messaging, underwent relentless testing and refinement using customer data. This strategy, later dubbed information-based lending, allowed Capital One to reach customers that other banks dismissed entirely. By understanding risk with unprecedented precision, it could extend credit to people who typically found themselves shut out of the traditional financial system, and make money doing it. A new financial paradigm takes root. Inside Capital One's walls, Morris and Fairbank each took on different roles. While Morris focused on building robust behind-the-scenes systems and attracting top talent, Fairbank drove marketing initiatives and customer growth. Together, they cultivated a corporate culture that thrived on experimentation and fresh thinking. But as Capital One's star rose, regulators started paying closer attention. In 2002, after financial misreporting scandals rocked other credit card companies, Capital One found itself under the regulatory microscope. In 2008, as the global financial system teetered on the brink of collapse, Capital One faced its greatest test. The housing market crash triggered bankruptcies and job losses across America, hitting Capital One hard. In a single devastating quarter, the company reported staggering losses of $1.4 billion. Yet unlike some floundering competitors, Capital One had prepared for catastrophe. Its risk team had modeled worst-case scenarios and stockpiled resources accordingly. It had built systems evaluating individual customer risk with remarkable precision, tools that helped the company weather the storm, while larger institutions faltered. Capital One's success in leveraging data and technology marked it as a fintech pioneer before the term fintech even entered the business lexicon. It showed how financial products could be personalized at massive scale using data, creating a blueprint that's been replicated ever since. After departing from Capital One, Nigel Morris joined forces with Frank Rotman to launch QED Investors, a firm specializing in early-stage fintech companies worldwide. Since its founding, QED has backed more than 225 startups, several of which have blossomed into billion-dollar enterprises. Meanwhile, Capital One has grown into one of America's largest banks, with a market valuation exceeding $50 billion. The Capital One story mirrors the fintech story broadly. Innovation rooted in data, tested through crises, and driven by visionaries who saw opportunity where only others saw risk. From humble beginnings, it launched an entirely new approach to financial services. Making payment painless. Few finance innovations start with a funk concert, but that's exactly where the seeds of Venmo were planted. In 2009, two friends found themselves in a Philadelphia music venue, enjoying the show from the balcony. They felt frustrated that they couldn't easily tip the band without trekking through the crowd. For Andrew Cortina and Ikram Magdon Ismail, this minor inconvenience sparked a question. Why couldn't they just text money to the performers? The pair were well positioned to tackle this challenge. Magdon Ismail had spent his childhood across Zimbabwe, Zambia, and Uganda, experiencing firsthand how different cultures handled money and weathered currency fluctuations. Cortina's modest New Jersey upbringing had taught him to make the most of limited means. Their complementary perspectives first merged as roommates at the University of Pennsylvania, where they bonded over guitars and weightlifting. After graduation, the pair tried their hands at various startups, a student marketplace, music websites, even point-of-sale software for a yogurt chain. When these ventures fizzled, they temporarily parted ways to gain industry experience. But what finally crystallized their vision was a forgotten wallet. When Magdon Ismail visited Cortina in New York and realized he'd left his wallet in Philadelphia, Cortina covered the evening's expenses. This everyday hassle of paying back a friend highlighted a universal problem begging for a solution. Within weeks, the friends had built their first prototype, a simple system that let users send money via text message. The name they chose reflected their mobile-first approach. Venmo, combining the Latin vendere, meaning to sell, with mo for mobile. While they couldn't have known it then, this solution to a forgotten wallet would eventually process over $250 billion in payments annually. Becoming a household name. Sometimes success emerges from the brink of failure. By 2012, Venmo had attracted 5,000 active users and secured $5 million in funding, but a fatal flaw threatened to sink the company. In its eagerness to attract users, Venmo had made a critical mistake, allowing free credit card transactions. Users quickly discovered they could game the system to earn credit card rewards without spending real money, creating an unsustainable drain on the company's resources. With just 2 weeks of operating funds remaining, salvation arrived through an unlikely source. Braintree, a payment processing company led by CEO Bill Reddy, acquired Venmo for $26.6 million. The timing was perfect. Braintree needed a payment solution, while Venmo desperately needed financial stability and infrastructure. A year later, PayPal would acquire both companies for $800 million, providing the resources for massive expansion. Even under corporate ownership, Venmo maintained its quirky spirit. Its Lucas Uses Venmo marketing campaign transformed an ordinary engineer into an internet sensation through mysterious billboards across New York City, sparking social media buzz and memes. This creativity helped fuel Venmo's growth as it competed with Square's Cash App in an increasingly divided market. Venmo dominated urban coastal areas, while Cash App captured rural regions and the South. By 2023, Venmo had 85 million active users. But perhaps its most significant achievement wasn't financial, it was cultural. The phrase, "just Venmo me," had become part of everyday language, particularly among younger generations. What began as a solution for splitting bills had evolved into something more. Venmo had changed how an entire generation handles money. Banking for startups. One evening in 1983, a poker game between two Bank of America executives sparked a conversation that would change the face of startup financing. Their idea was simple enough: create a bank for a particular class of clients that other financial institutions deemed too risky: young tech companies and their venture capital backers. This was the genesis of Silicon Valley Bank, or SVB. Based in Santa Clara, California, at the heart of the technology industry, SVB carved out a unique niche by offering services traditional banks wouldn't dream of providing. While other banks saw startup companies as liability-laden gambles, SVB recognized an opportunity to grow alongside these ambitious ventures. The bank's approach was methodical and patient in its early decades. Rather than chasing quick profits, SVB built deep relationships within the innovation ecosystem, connecting entrepreneurs with investors and offering specialized financial products tailored to the unique needs of growing technology companies. This strategy proved successful. By 2019, after 36 years of steady growth, the bank had accumulated $100 billion in deposits. Then came 2020, and with it, a perfect storm of circumstances that would elevate and then endanger SVB. As the COVID-19 pandemic pushed interest rates to historic lows, venture capital funding exploded. Tech startups, flush with investment cash, poured money into SVB at an unprecedented rate. In just 12 months, the bank doubled its deposits to $200 billion, matching in a single year what it had taken over 3 decades to build. This dramatic expansion catapulted SVB from a specialized regional bank to the 16th largest financial institution in the United States. Its client roster read like a who's who of technology success stories, including Airbnb and Pinterest. The bank that started with a poker game had become a pivotal player in the global technology industry. Yet this meteoric rise contained the seeds of SVB's eventual downfall. The same surge of deposits that exemplified its success would soon force crucial decisions about how to invest this massive influx of cash. Decisions that would ultimately lead to one of the most spectacular banking collapses in American history. In March 2023, rising interest rates devastated the value of SVB's government bond investments, triggering a modern-day bank run as customers withdrew $42 billion in a single day. Within 48 hours, the 16th largest bank in America had collapsed, requiring federal intervention to prevent an industry-wide crisis. The bank that had built its reputation on understanding startup risk had ironically been undone by mismanaging the most traditional of banking fundamentals. Betting on outliers. When Mario Schlosser's wife became pregnant, he found himself lost in America's labyrinthine healthcare system. Between Google searches and friends' advice, he couldn't find clear answers about childbirth costs or reliable pediatricians. This frustration sparked an idea that would transform health insurance: Oscar Health. Drawing on experience from his previous venture in gaming, where he had designed virtual economies to keep players engaged, Schlosser applied similar principles to healthcare. Just as games used timed events to ensure players returned frequently, Oscar Health created systems to encourage healthy behaviors. Members who met daily exercise goals earned Amazon gift cards, while getting a flu shot could result in cash rewards. The strategy worked. Oscar Health achieved unprecedented customer satisfaction scores and eventually went public at a $5 billion valuation. But the journey to success wasn't smooth. The company weathered serious threats when the Trump administration moved to dismantle the Affordable Care Act, and only survived through strategic adaptation and a crucial $375 million investment from Google's parent company, Alphabet. Oscar Health's story illustrates a broader pattern in financial technology. Success often follows the power law, where extraordinary returns come from rare outlier events. This principle shapes both insurance and venture capital. While insurance companies bet against unlikely catastrophes, venture capital firms actively seek them, in the form of breakout successes. Research from Stanford professor Ilya Strebulaev demonstrates this dramatically. Remove the top investment from most venture capital funds, and they plummet from the 95th percentile to the 30th. A single successful bet can return an entire fund many times over. This explains why even established venture firms have broadened their investment approach to ensure they don't miss potential unicorns. The venture landscape itself is evolving. Leading firms now emphasize providing operational support beyond mere capital, recognizing that money alone no longer differentiates investors. This transformation of both insurance and venture capital reveals a key insight. In finance, the most significant innovations often come from understanding and embracing uncertainty. Whether it's Oscar Health's gamification of wellness or venture capital's pursuit of outlier returns, success depends on turning unpredictability into opportunity. The main takeaway of this Blink to Fintech Wars by James DaCosta is that transformative financial innovation often comes from outsiders who recognize opportunities that others don't. From Capital One's data-driven lending to Venmo's social payments, Silicon Valley Bank's tech focus, and Oscar Health's gamified insurance, these companies succeeded by challenging conventional wisdom and cleverly leveraging new data and technology. What began as a niche sector has grown into a global industry. Today, fintech covers everything from mobile payments in developing countries to cryptocurrency trading. These groundbreaking companies didn't just build businesses, they changed how we save, spend, borrow, and invest. Okay, that's it for this Blink. We hope you enjoyed it. If you can, please take the time to leave us a rating. We always appreciate your feedback. See you in the next Blink.